Darren, let's talk about domestic equities first. As you know, they had a stellar start in January, but unfortunately gave back much of those gains in the final 2 months. Can you talk a little bit as to why we saw that first quarterly decline in over 2.5 years?
Yeah, thanks, Nicole. It was a great start to the year. Really strong first quarter with the S&P up 5%. Unfortunately, it was too good. And I think what that did was it caused people to start thinking about the economy is that good. If things are going this well, maybe the Fed needs to hike rates a little bit quicker than what they've talked about in the past. And then in the beginning of February, we got the jobs number, 200,000 plus jobs added, a good number. But more importantly, 2.9% increase in wages year over year. That's the highest we've had in 9 years. So all of a sudden, wage inflation is picking up, which hasn't happened during the whole entire recovery. And when wage inflation picks up, it contributes to overall inflation. Overall inflation usually drives rates higher. So all of a sudden, the economy, which had been predicting maybe 2 rate hikes by the Fed this year, 3 was on the table, and then maybe even 4. So interest rates started to move higher in a very short period of time. 10-year started the year at 2.3. All of a sudden, it was over 2.9. We had a 50 basis point jump in interest rates in a very short period of time. Made investors nervous. Some money left equities, went into bonds, some went into cash. But overall, people just got nervous about interest rates rising faster than what was priced into the overall market. We got an inflation reading in the middle of the month that confirmed inflation was rising. Rates again pushed higher. So areas of the market that are interest rate sensitive, such as consumer staples, utilities, REITs, those areas really struggled, whereas the growth sectors actually held up fairly well. So if you look at the overall returns for the market, it was down 0.75%. Growth stocks were actually up and value stocks were down. So value stocks dropped enough to kind of overtake growth. But for the most part, interest rate sensitive areas of the market really struggled as rates moved higher. This whole concept of things being too good and the Fed having to get more aggressive really scared investors. And then we had some issues in Washington with cabinet changes and tariffs, and that increased our uncertainty about what's going to happen. And as we all know, investors hate uncertainty. So investors became more cautious. So as the quarter went along, we saw a sell-off, a couple of big drops in the market. It recovered a little bit in March, but again, we finished the quarter down in negative territory for the first time, as you mentioned, in 2.5 years. And it was really things too good, interest rates rising a little fast, and a little bit of uncertainty. And investors entered the year very complacent. They were used to getting nice returns without much risk, and you saw a sell-off because of that. And that's really what drove stock prices down and the indices down in the first quarter.